Hi there, you're watching Market Cafe on ET Now with me, Shreyanshi Singh, and over the next few minutes, I'll get you news and updates from within the country as well as across the globe. Also tell you which stocks you should be keeping on your radar as well. But first things first, let's take a look at the handover coming in from the Wall Street as well as what the year has been like for Wall Street. Now, the S&P 500 has surged more than 23.8%, putting it solidly on pace for its second consecutive gain above 20%. When you take a look at the Dow as well, in terms of the year-to-date move that we've seen, that has also added nearly 13%, while the Nasdaq Composite is the one that has outperformed with a 29.8% advance as well. So that's what the year looks like for Wall Street in terms of what 2024 looks like. But despite the strong year-to-date performance, though, you do have Wall Street entering the final day of the year on a sour note as the market has lost some of its momentum in the last few sessions. So December has been a weak stretch for equities as investors take some profits in some of 2024's biggest winners then, and fears also mount over rising rates into year-end. Now, you do have the loss in momentum that has also dashed investor hopes for a Santa Claus rally. That is something that we've been talking about for a while, which occurs when the market rises during each of the 5 final trading days of a calendar year and the first 2 trading days as well of January. Now, when you take a look at the Dow, that finished Monday's choppy trading session with a loss exceeding 418 points. So just about 1% thereabout coming in for the Dow as well. The S&P 500 as well plunged about 1%. Nasdaq also shed over 1.1%. Is the kind of loss that you're looking at least when it comes to Nasdaq as well. The market, of course, is closed on Wednesday for New Year's Day, but that largely is the kind of handover that we're looking at on a daily as well as a year-to-date basis as we wrap up the year for Wall Street. But let's also get you a quick check then going on oil prices then, because oil prices did settle higher on Monday in thin trade. Now, of course, the trading was thin due to the truncated week and the volumes were low, and that is something that we've been looking at in terms of a range-bound trade coming in since October as well for oil prices. But investors are betting on a drop in temperatures across the US as well as Europe over the coming weeks to boost diesel demand as well. So that is something that we're looking at. When you take a look at price moves though, we're looking at Brent crude having an uptick of just about 22 cents or 0.3% thereabout. $74 a barrel is the kind of level that you're looking at, and the more active March contract then settle around that $73 a barrel mark as well. Uptick of 20 cents is what you're seeing there as well. But let's also take a quick look then at natural gas prices, because they're the ones that surged, hitting a new 52-week high following reports of a colder than usual temperature outlook for January as well. So that's largely the kind of handover that we're looking at for both oil as well as natural gas. But with that, let's get you a check going on China's November factory activity growth. That is something that missed analysts' expectations on Tuesday, signaling that Beijing's stimulus measures were not sufficient to meaningfully boost the country's ailing economy. Now, the country's official Purchasing Managers Index for December came in at 50.1, according to data released by the National Bureau of Statistics. And that is something that we were looking at. Now, the reading did miss the expectations that were being penciled in of 50.3. When you take a look at manufacturing activity as well, came at 50.3 in November and 50.1 in October as well. Now, PMI reading above 50 for context indicates expansion in activity, while a figure below that also points to contraction. So that is the handover largely that we're looking at, and investors will of course be monitoring the Caixin or S&P Global Manufacturing Purchasing Managers Index. That is also slated for release later this week as well. So that is something that we're looking at. In terms of Asia though, let's get you a quick check going then on what the Asian markets are doing. And we're largely looking at a mixed handover at this point when it comes to Asia. So Asia Pacific markets trading mixed. On your screens, you do have Nikkei downtick of about 1% coming in for that one. Let's also get you a quick check going on Hang Seng as well as Shanghai, see what they're up to as well, because Hang Seng is holding on to a tinge of green as we speak. Let's get a check going on Shanghai as well as ASX 200, because Shanghai is the one that is on the flip side. While you do have Hang Seng that's holding on to a shade of green at this point, Shanghai is the one that is holding on to 0.2% losses coming in as well. ASX 200 also holding on to a tinge of red as we speak, 0.6% downtick coming in for that one as well. Lastly, let's get a check going on South Korea's Kospi, because that's the one that's been flip-flopping between a green and a red throughout the course of the last week as well. On your screens, you do have Kospi, 0.6% downtick coming in for that one as well. So that's the kind of handover that we have, at least when it comes to the Asian markets. But with that, let's get you a list of global cues that you should then watch out for. And in terms of global cues, firstly, when you take a look at cues from China, you do have composite as well as manufacturing and non-manufacturing PMI data sets as well that we're looking out for, like I've mentioned earlier as well. And back home, you do have November fiscal deficit data that we're also keeping an eye on from the US. There's house price index data sets as well as API weekly crude oil stock. Now, that is something that we've been watching out for, especially with the range-bound trade that we have for the oil markets. This is going to be an important one to watch out for because based on the crude stockpiles, that is something that we've been monitoring very closely, at least when it comes to oil prices. So that is going to be the one to watch out for in terms of data sets coming in from the US. But moving on then, nearly 2 days after the deadly plane crash in South Korea, killing 179 passengers, the country has ordered safety inspections of all Boeing 737-800, even as officials are yet to determine the exact cause of the plane crash. Meanwhile, Boeing shares fell sharply after South Korea's acting president Choi Sang-mok ordered an emergency inspection of the country's entire airline operations. South Korean officials, meanwhile, said that they will be conducting safety inspections of all Boeing 737-800 aircraft operated by the country's airlines. Jeju Air's Boeing 737-800 plane also attempted a belly landing, overshot the runway and later burst into a fireball. It had aborted its first landing attempt and also encountered a bird strike during its second landing attempt. Now, the pilot had also issued a distress signal, so that's the latest coming in as far as that disaster is concerned. Moving on then, pending home sales in the United States rose more than expected in November. That's the fourth straight month of gains as buyers focused on making the most of the improved inventory despite those lofty mortgage rates. The pending home sales index rose 2.2% last month to 79. That's the highest level coming in since February last year as well. And on an annualized basis, then sales were up 6.9%. So that's a check going on that data set as well. But keeping it with news flow from the US, then the US Treasury Department has said that a China state-owned actor responsible for a major cyber breach resulting in access to some of its workstations. Now, as per the allegations, a third-party software was used in the incident as well. The Treasury Department also described the intrusion as a major cyber security incident since it was attributed to a state-sponsored actor as well. So that's the latest in terms of those allegations then. Moving on then, despite the global luxury market seeing a decline in 2024, the Indian luxury retail space also witnessed good growth in the year gone by. What are the key reasons then driving this growth? What are the growth triggers? How is the outlook then shaping up for 2025? Let's take a look at this special report.
It doesn't seem like the luxury retail boom in India is going to come to a halt anytime soon. 2024 has been a good year for several luxury players in India, even as high-end brands curated their offerings for the Indian audience. But which segments drove this vogue of premiumization? While globally it is the beauty and eyewear categories that recorded the most robust growth, back home, however, it was Indians' consistent love for jewelry that took the crown. Simon Kocher reports that Indians used as much as 60% of luxury spends on jewelry and cosmetics, which is significantly different from its emerging market peer, China, which spent only 48% of its spends on the segment. Indians' love affair with weddings drove this consumption. More than 50% of gold jewelry sales are driven by weddings.
Now, out of this overall luxury market, our estimate based on all secondary sources is that jewelry would account for roughly half of that. And therefore, we are talking about 75,000 crores or around $8.5 billion. And we believe that should also continue to grow at that pace.
Growth in India's luxury spending is being propelled by rising wealth. Going forward, Knight Frank says that the number of Indian high net worth individuals is expected to rise by 50% in 2028, the highest among countries. In addition, Goldman Sachs also estimates that India will have 100 million affluent population by 2027. We're also seeing a steady rise in discretionary spends. In fact, per capita consumption of durable goods, healthcare and jewelry in the top 10% of urban India is 8 to 10 times higher than the national average.
The slightly more well-heeled households are not so much impacted by inflation because they also have a massive wealth effect by their holdings in gold and real estate and the stock market, right? And therefore, I think premium consumption in general or anything that is premiumizing is doing better.
Now, a strategy that is working well for the high-end global brands is the efficient use of GTM or go-to-market approach instead of opting for exclusive brand outlets. And most of these brands entered the Indian market through ventures with local retailers. Reliance's retail arm, RBL, dominates the Indian luxury retail space. The company has brought to the country 85 international brands, including the likes of Burberry, Bottega Veneta and Jimmy Choo.
I personally feel that maybe a few months initially in 2025 may not be as good. They might be flat or they will see slow growth. But the second half of 2025, I do expect very good recovery in the market. There is a lot of traction that is coming not only in apparel. There are two additional categories that we see. One is footwear and the second is leather goods.
Slowdown in China's spending has led to a degrowth in the global luxury market in 2024, and the outlook continues to be a bit bleak for 2025 as well. Bain Capital predicts that similar headwinds should continue for the market through the next year too. And if Trump establishes tariffs the way he has promised, growth prospects will turn gloomier. The same cannot be said for India though. McKinsey forecasts that retail sales of luxury brands will increase by 15 to 20% in 2025. India has firmly positioned itself to become one of the most attractive destinations for the luxury market. Bureau Report by Ruchira Kagita, ET Now.
Welcome back. Thank you so much for staying tuned in. Well, let's get you some more news and updates. Then, Indian economy and the financial system are strong and healthy as per the latest financial stability report by the Reserve Bank of India. In fact, the report also highlights that the banking and the non-banking sectors are poised for growth as well. In fact, my colleague Anjali Palod is standing by with more details. Anjali.
The RBI has released its biannual financial stability report for December 24, and the stress test revealed that under baseline scenario, GNP of banks would reach 3% in March 26 versus 2.6% as of September 24. Under adverse scenario 1, the GNPA would reach 5%, and if the situation aggravates further, which is adverse scenario 2, the bank's GNPA would reach 5.3%. As far as CRR is concerned, it is projected to fall to 16.5% in March 26 under the baseline scenario versus the current level, which is 16.6% as of September 24. Under adverse scenario 1 and 2, the CRR may drop to 14.3% and 15.7% respectively. For NBFCs, the GNPA at baseline would increase to 3.4% in March 26 versus 2.9%, that is the current level. The GNPA of NBFCs would reach 4.7% in medium risk and 6% in high risk. The CRR for NBFCs again is projected to reach 21.2% under baseline scenario, 20% in medium risk and 20.2% in high risk scenarios. Strong macroeconomic fundamentals, healthy balance sheet of banks and non-banks underpin Indian economy and the domestic financial system, the RBI has said. Global economy remains resilient and the near-term risks have receded. Stretched asset valuations, high public debt, prolonged geopolitical conflicts and risks from emerging technologies are currently posing medium-term risks.
Alright, and thanks Anjali for getting us that update then. But moving on, rising MFI slippages could keep the stress elevated in banks, and that's the word coming in from UBS as well. They're maintaining a buy on their preferred banking picks, the likes of HDFC Bank, ICICI Bank, as well as Federal Bank. Varun is joining in with the key takeaways from that note. Varun? Varun, when it comes to this particular note then?
Okay, right. So you're speaking about the report of UBS on banks. So UBS actually highlights that the overall microfinance portfolio at risk has gone up by around for 0 days, has actually gone up by 110 basis point month on month in the month of November. And if you look for September to November, it has actually gone up by around 240 basis point, and from March 2024 it has gone up by around 620 basis point, and it currently stands at around 18.6%. The overall slippages, if you look in the second half of FY25, is expected to be higher when compared to first half of FY25, and the overall stress in the system, it is not expected to peak out in Q3 as well, which was actually expected by some of the management. This is what UBS is saying, and because of this, the overall growth rate in FY25 is expected to remain muted. Although in the month of October, if you look, the overall collection efficiencies were a bit subdued because of floods, festivals in some of the geographies, but they have now recovered in many of the parts in the month of November. So that is one good point. But yes, the overall PAR 0, if you look at that has increased in the month of November on a month-on-month basis, and also from when you compare to month of March. They are neutral on the sector, but their preferred pick are HDFC Bank, wherein they have a buy call. ICICI, they have a buy call. Federal, they have a buy call. HDFC, they have a target of 2100, ICICI 1575, and Federal Bank, they have a target of 250 rupees.
3 of their preferred picks, and that's the word coming in from UBS as well. But moving on, let's get you a check going on the stocks that you should then be keeping on your radar then, and Ria is joining in with just that list.
Yes, good morning. Let's take a look at the stocks that are going to be in focus today. First up, we have Lupin. Now, they have acquired Hume's insulin in India from Eli Lilly and Company to further enhance its diabetes portfolio. We also have Reliance Industries in focus today. The subsidiary Reliance Digital Health Limited has acquired 45% equity stake on a fully diluted basis in Health Alliance Group Incorporated for an aggregate consideration of $10 million. Also, keep your eye out on Mazgon Dock, since the government has signed a rupees 1,990 crore defence deal with the company to construct an air-independent propulsion or an AIP plug for submarines. There's also RVNL in focus on the back of yet another order win. They've emerged as the lowest bidder for an order worth rupees 137 crores from Central Railway, and this is to be completed in a period of 24 months. Lastly, also keep your eye out on Power Grid Corporation and REC, since they have acquired the Rajasthan 4A Power Transmission Limited under the TBCB route for rupees 18.4 crores from REC, and further Power Grid has also transferred 26% residual equity shareholding in 4 associate companies to Power Grid Infrastructure Investment Trust for rupees 506.6 crores. So keep your eye out on all of these stocks today.
Alright, and that was all that we could pack for you in the last edition for this year of Market Cafe on ET Now. With that, time for a quick goodbye then, and we'll see you on the other side for the market.
If you like this video, then like, share and subscribe to ET Now.